Rick Santelli has the bond report for us. Hey, Rick.
Hi, and indeed, maybe the debt ceiling is another issue that we ought to mention because it's going to change the complexion of issuance, especially from a T-bill perspective. Now, let's look at 2-year and 10-year on one graph over the last couple of days. A couple of key points here. First of all, remember, durable goods was weaker than expected on the headline. If you stripped out transportation, it improved a bit. But capital good orders, non-defense area proxy for capital spending by business was weak as well. Now, it's been weak over the last handful of months, October of last year, but we want to pay particularly close attention. Now, on those charts, you notice that the 10-year yields are now below Friday's lowest yield. The long end of the market is taking the lead to lower yields. And when that happens, you're looking at what we call a bull flattener, meaning prices are going up, yields are going down, and the yield curve is getting flatter. Right now, it's hovering around 47 basis points between 2s and 10s. And do remember, briefly, we were over 60 basis points when we were really looking at long end moving higher in rates. Now, 30-year across the globe is getting so much press, especially in Japan. But do remember, benchmarks aren't 30-year bonds. But having said that, let's look at a 2-year chart of the 30s here, the 30s in the UK, and the 30s in Japan. And something should jump out at you. The 30 years are off to the races. And indeed, they ruin the scaling. They're so off to the races. Moral of the story is, yes, yields have gone up on the long end internationally, but in Japan, it's gone up to the extent that you really have to question that controlling interest rates for so long seems to have a rough payback. Leslie, back to you.
All right, Rick Santelli, thank you so much.